Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Nouriel Roubini of NYU and Hudson Bay Capital proposing a solution, writing, quote, to resolve their current tensions, Canada, Mexico and the United States should start drafting plans for a North American economic union. Nouriel Roubini joins us now for more. Nouriel, welcome to the program, sir. Thanks for making time for us. That's quite a statement. Just go through the way you're thinking about it. How on earth would this work?
Well, for now, we have only a free trade area between U.S., Canada, and Mexico, and there are already tensions involved. There's nothing, not only to do with, of course, drugs, fentanyl, and migrants, but the U.S. is also concerned about the trade imbalance between Mexico, U.S., and Canada. They're very large trade surpluses with the United States. So you can renegotiate the USMCA in a direction of restricting trade, and U.S. is now probably asking Mexico and Canada to also restrict trade in automobiles. There may be 20-25% tariffs on that because there are lots of job loss in the U.S. Or you can do something that is more bold, forming a full economic union that would imply free trade not only in goods, but also in services, in the movement of capital, labor, data, technology, and information. That's what the European countries have done for the last few decades. And from any economic point of view, North America is an optimal trading area that goes beyond goods. Now, one step you can take along those lines before having a full economic union could be, for example, to form a custom union. What's the difference between a custom union and a free trade area? In a free trade area, there is no common external tariff against other countries. So, for example, there are lots of Chinese cars that are now entering into Mexico, while the U.S. has a 100% tariff against Chinese EV. If you form a custom union, the first step for economic union, you'll have to have the same tariff imposed on Chinese cars, whether they go to Mexico or U.S. or Canada. And in this way, you create a full market, for example, for automobiles, and you prevent the imposition of, say, 20-25% tariffs on exports for Chinese cars or parts from Mexico to the United States. So you can do a reform of the trade agreement in the direction of shrinking trade, or you can do it in a direction of expanding trade. And I argue that actually it's an economic benefit of all three countries to expand trade through first a custom union and then a full economic union.
You offer a different vision then first, before we get to the much bigger one later. Can we just talk about the much bigger one? Freedom of labor, free movement of labor between the United States and Mexico just sounds like a complete non-starter. Nouriel, do you actually think that could be a stepping stone further out down the road in the future?
Well, in the case of the European Union, you had the same problem. The countries that were much poorer in Central Eastern Europe, they joined the EU. There was a transition period of many decades until they reached a certain level of per capita income, a certain level of governance, a certain level of reform. Of course, free trade in labor between US and Canada would not be a problem, same per capita income, same culture, language, and actually there'll be probably more people going from US to Canada than the other way around because of global climate change and cheap land in Canada. With Mexico, of course, at current level of per capita income, you cannot have free trade in labor. But as I said, like in the case of Europe, you could have standard criteria that suggest that maybe after 10 or 20 years, when Mexican per capita income is much higher, there's better governance, then you free up that type of trade. So I'd say that in economic union, the part that is controversial is only probably migration of labor. It will be in the interest of the United States to have free trade in goods, in services where it has comparative advantage, in the movement of capital, portfolio and FDI, and of course data information technology where the US has a major comparative advantage relative to Mexico and to Canada. The only controversial part, as I said, is labor movement, but you can restrict it over time.
Nouriel, do you get the sense that anyone in the current administration is sympathetic to this type of proposal at a time where it seems like people are increasingly going for economic isolation rather than reducing the walls entirely?
I will start conversation within the administration on this matter, but I would say that certainly a step towards reforming the USMCA in the direction of a custom union makes sense. Because right now, of course, the automakers, that are the producers, are very worried about the impact on their own production costs and profit margins of restricting and imposing a lot of tariffs on, say, auto trade. The unions and the workers are in favor of it. But the problem is that if you're imposing this 25% tariff on automotive trade, the cost of cars in North America is going to increase by 10, 20%. That's going to hurt, first of all, consumers, but it's going to also hurt the workers. So if you care about U.S. auto workers, there are two options. One, to impose the tariffs and restricting trade in automotive, but that's going to be bad for everybody. Another one is instead having a custom union, where if you essentially have an external tariff that is common against Chinese autos, then Chinese autos that are not entering the United States today will not enter Mexico either. And therefore, the market for U.S. automakers is going to be much bigger because you have 120 million Mexicans that need auto and are buying now mostly Chinese cars. So you can have a win-win solution that makes everybody better off, including the auto workers, if you go in the direction of a custom union and eventually an economic union. So you have to go forward rather than going backward. And I think that those arguments can be made in Washington, in Mexico City, and of course in Canada as well.
Nouriel, is this proposal potentially a way that the United States could have more heft when it comes to driving a wedge between Beijing?
Well, certainly one of the concerns that the United States has is not just fentanyl that is coming to the U.S. Via China, but more importantly that the Chinese have avoided tariffs by essentially exporting goods to Mexico and from Mexico to the United States as if they were Mexican goods. The Mexican production of many goods has a lot of content of parts that is Chinese. And there is also concern about the fact that the Chinese are taking over the auto market of Mexico as well, exporting cheap cars, EVs and otherwise, to Mexico. So if you care about de-risking the relationship with essentially China, whether it's in auto or other critical parts of the economy, it makes sense to have initially a custom union and then having also a full economic union where decisions about how much you trade and do investment with China from North America are done not by the U.S. side alone, and then Mexico can do whatever they want as they do right now, but have it in the context of an economic union and initially a custom union. So it makes sense for the U.S., it makes sense for North America.
Nouriel, provocative as always. It's good to catch up with you, sir, and I should say thanks for making time for us. I know you're on a bit of a world tour, so looking forward to catching up with you when you're back in New York. Nouriel Roubini there of NYU Stern and Hudson Bay Capital. We begin this hour with stocks lower, struggling to snap a 4-week losing streak. Seema Shah of Principal Asset Management writing, whether the rally can reassert itself and deliver positive equity returns going forward will likely depend on whether earnings growth can deliver. Seema joins us now for more. Seema, welcome to the program. Can it deliver relative to expectations? So let's talk about expectations. Have they pulled back sufficiently over the last several weeks?
Hi, John. I don't know if it necessarily has. I mean, we've already seen a couple of downgrades to economic growth forecasts. Actually, from an earnings perspective, I don't think it's moved down enough, particularly when you start to think about the 2nd of April and the amount that could happen to global stocks, global earnings. So I think there's a little bit further to go. You know, we need to see a number of other, boosts coming in the second half of the year. But I think for the next couple of months, it's going to be a really rocky road.
Seema, some of the retailers have come out and said that the next year could be difficult. They've lowered expectations. Delta Airlines, the airlines group, have done a similar thing over the last several weeks as well. Which parts of the market do you think are more vulnerable going into earnings season?
So I think anything, of course, anything which has got any kind of international revenue exposure, anything which is linked to consumers. The things that we're really concerned about with the consumer is just what we're seeing with regards to price increases the pressures that people are having on household income. So actually it's spread across so many sectors because there's so much significant exposure. There are parts of the market which we think are a little bit less vulnerable. Places like financials, which have had a bit of a pullback, it could see some return. But so much really depends on what can we expect to come through from a stimulus perspective, not just from the Fed, but in terms of, what happens to tariffs in the second half of the year? Are some of them going to be lifted? Are we going to expect to see deregulation? If that comes through, then there are parts of the market that stand to gain over the coming months. But as I said, I think the jury is out until we have some further clarity of where this administration is going with a number of their different policies.
And there also needs to be some clarity, Seema, on some of those inflationary pressures that you were referring to, both with respect to households and what that does to their spending capacity, as well as to companies and their ability to pass it along to said consumers. Do you have a sense of whether so far some of these price pressures are actually inflationary or whether they have the seeds of being disinflationary down the line in tandem with weaker growth?
So actually, I don't think there is any clarity at all. I think we're hearing really contradictory stories. About a year ago, we were talking to a number of our larger clients who had told us that typically you can pass on price increases twice. Consumers can handle it twice. The third time is a complete no-go. And we're almost looking at that third time now. On the other hand, we are hearing some small businesses who are saying that there's so much uncertainty and they cannot be left out of pocket. So they're already starting to increase prices ahead of what could be reciprocation on tariffs on April the 2nd. So actually it's a very, very varied story, which of course it doesn't help businesses, companies, investors really plan ahead.
At the end of another week where my mind feels somewhat fried, I wonder if people are just getting sick of all of the uncertainty in the United States and are looking for the certainty of the budget that was just passed in Germany, the certainty of other regions in the world that might be engaging in fiscal stimulus. Do you jump on that train, or do you think that that sort of haven from uncertainty or just another story, another narrative, do you think that that's basically played out as people realize, okay, it's going to be more complicated?
So it's funny. I've been in Madrid all of this week speaking to clients, and it was interesting from their perspective. They're a little bit more skeptical than I'm finding the US audience to be. They're looking at this and they're saying, look, this is really great news for Germany without a doubt. But in terms of how it feeds through to Europe, they're still unsure of really what the positive repercussions could be. They don't really think there's going to be major fiscal stimulus from their countries. And even if there was, they're worried about what happened to debt markets there. And on top of that, from their perspective, the real game changer that they're looking for is deregulation in Europe, which unfortunately is not something that they are particularly optimistic about. So I think there is some potential, certainly, that there's good news, at least in one part of the world rather than the other. But how far this can go in the near term, I think is questionable. And certainly we think there could be a near-term pullback for European equities as you start to see some reality set in around what's happening with tariffs and really, how quickly this fiscal stimulus can actually feed through to the German economy, let alone the European economy.
So, Seema, are you challenging this idea that the ball of exceptionalism is shifting over to Europe and China and elsewhere and away from the United States, that's maybe overly simplistic and it's just getting more complicated with a less clear path to which area and which stocks are going to outperform? Is that kind of how you see things?
So I think that the near term is a little bit cloudier than many people have been thinking. I think the near term, there's been so much positivity around the fiscal stimulus news, but there's still, as you said, a lot of things with regards to the tariffs, how quickly the fiscal stimulus can be passed through, that in the near term, some of that optimism around international equities could take a bit of a setback. The other thing that we're thinking is that US exceptionalism shouldn't necessarily be in question. We do think that the US is still going to see superior growth going forward. But is it going to, does that necessarily stop European equities, Chinese equities from doing well? Even a move to benchmark positions for so many investors would be a significant tailwind for equities. So it's just that the world is a bigger place now. There are other opportunities for investors and if you haven't had a chance in the last couple of weeks to get onto that ride, you probably will see an opportunity within the next few months.
Seema, when it comes to the uncertainty in the United States around tariffs, is April 2nd then going to be a clearing event?
Well, on one hand, yes, we hope that there will be some kind of certainty coming through. That is the one thing which is overhanging, particularly for global investors or investors looking at international equities. So I think there'll be some clarity. Does it really clear up everything that we are waiting to hear? I guess I'm fairly pessimistic on that, but at least we're getting to a process that at some point within the next few months, we know some kind of direction where this administration is going, and then businesses can plan. So that's why for the second half of the year, we have a slightly more optimism, because we think some of the uncertainty will clear up.
The life of a European-based strategist here, Lisa. Sprinkle of Madrid, a little bit of London, quick trip to Rome. Sounds all right, doesn't it?
Well, I think that we're both really tired.
Plus Germany's spending too, some deficit spending.
Just head over there.
It's all adding up.
Yeah, but as long as you don't fly to Heathrow.
Before, it didn't make sense at all.
Yeah, well, but I will say it's interesting that in Spain, they're not particularly interested in what Germany's doing as being the holy grail, considering that it doesn't necessarily open up the purse strings for them. And frankly, it might make them more in a difficult spot because of what spreads are doing on the periphery.
Seema, appreciate your time as always. Seema Shah there of Principal Asset Management. We begin this hour with stocks lower. Kate Moore of Citi Wealth writing, sentiment has weakened but not fully collapsed, and absent full capitulation and with persistently high uncertainty around tariffs, growth and policy, we believe it is too soon to step in. Kate joins us now for more. Kate, good morning. Good to see you.
Yeah, thanks, John.
Congratulations on the new seat as well. It's
Thank you.
the first time we've seen you since you moved over.
I had a nice break, and I've been getting ramped up at Citi. You know, it sort of pains me to have to write what I just wrote and what you read. You know me, I like risk. I've always liked to look at opportunities. I like to see when there are dislocations and say this is a nice time to step in. And right now, to the conversation you guys were just having around uncertainty, not just in terms of the macro forecast, but also in earnings, it's almost impossible for me to say we've seen the bottom, we can break out of this trading range, and it's time for us to add.
There's always a price. Have we reset price low enough? How much more do we need to do that? Have we reset expectations sufficiently? What would you look for that would change your mind, that a risk reward would become more compelling?
Well, one of the things that I keep getting my head stuck on is everyone's focus on PEs, right? On multiples and valuation. And they keep on saying over and over again, you know, we've derated a little bit. It's now looking a little bit more attractive. And I say, that's great. We have no faith and confidence in the denominator. And against that backdrop, if you don't know what you're measuring yourself against, like, are we cheap? I don't think so. Look, there are super high quality companies in the U.S. I know we've had some rotation away from those companies over the last couple of weeks of trading. But, you know, that doesn't mean we need to step in and kind of back up the truck and add back to those companies right now. And I hate, as I said, sitting on my hands a little bit because, like everyone else in this business, I have a bias to action.
How inconsistent are some of the projections that we're getting right now out of Wall Street?
Oh my gosh.
Well, on one hand, you've got, I know, it's a big question. You want to just start there?
Yeah, no, this is, I mean, it's a terrible time to have to put out forecasts. I'm fortunate enough to not have to put a target on the S&P or say, here's my technical buying level or here's my earnings expectation at the moment, because it is going to be a losing game at this moment. We could get to April 2nd and have some clarity. I would put a much higher probability that we don't have clarity after April 2nd. And so people are going to have to make these constant revisions. And especially, as we were talking about before, corporates don't know what's going to happen. One of the things I'm worried about and / watching as we go into this next earnings season is not just whether or not companies take down their guidance, but whether or not they pull guidance altogether. If they say we don't have enough information to even reaffirm or adjust or even take down what we've given you before, we're going to step back. That tells us that kind of all bets are off and kind of continuing to sit on the sidelines makes some sense. Now, to be fair, for like Citi Wealth clients who have, you know, multi-asset portfolios, we're not saying sell, but, you know, there are a lot of folks that have big cash balances, and we want to be convicted when we say put that cash to work.
That was what I was just going to ask. What does sitting on your hands actually mean in financial terms? Does it just mean sitting on cash? Does it mean sitting on gold, going to London?
It's not making big asset allocation decisions right now. Let's wait for more information, and whether that's, you know, tweaking our equity allocations or looking for more opportunities across the fixed income or alternative space. Like, we don't need to do that right now. Let's wait for, hopefully, what will be a little bit more clarity.
Do you think you're going to have the conviction after April 2nd to maybe make some of those decisions?
I think April 2nd is an arbitrary date. I mean, it is a point at which we will have some information on tariffs, but we won't have a significant outlook for the entire policy program in the U.S. And until we have that, it's pretty hard to say, you know, what the growth forecast should look like. this is what I would also say. We have a pattern of behavior from this administration over the last couple weeks or a couple months that suggests there's, a constant revisiting of their own targets and what pain they're willing to take, even as they stay focused on what they believe their big goals are. And the communication has not always been consistent to the corporate sector and to the investment community. And I don't know that that changes just because we get to April 3rd.
One thing is consistent. The president this morning, just minutes ago, saying April 2nd is Liberation Day in America. But to your point, to a lot of people's point, they're not expecting April 2nd to be the end-all, the be-all. If uncertainty is a feature, not a bug, how do you do this for 4 years?
I think you're going to have to stay really focused on the areas where you do have certainty. I always have a bit of a laugh when everyone says we want to own quality companies. No kidding. There's no point in the cycle where you don't want to own a quality company. And like any fund manager or investor says, I don't care about quality. I think you should probably head for the door. But what we're looking for, I think, in an environment where there is a lot of uncertainty is earnings sustainability and earnings stability basically in general. We want companies that can earn through all parts of the economic cycle, that have strong products and business models and really outstanding management teams that we can have faith in. When it comes to fixed income, we're going to have to see what happens to the inflation and growth side. So I can't say for sure what that kind of uncertainty will mean for that allocation.
The new policies are confusing. The administration, they seem to change every day and they can change again very soon. And they will do on April 2nd and maybe again multiple times after that as well. That's hard enough. Understanding how the rest of the world responds to it is equally as complex. How much has Europe's response to this complicated how we allocate assets in the United States?
Look, I know people have gotten really excited about, closing their underweights. I'm not going to say going explicitly long Europe, closing their underweights to Europe. And they've said, look, there's some of these pockets of fiscal stimulus, something we haven't gotten in a long time, and they've gotten really excited. I don't think that we can say we're going to make a wholesale regional equity change based on a few policy announcements. And unfortunately, and I hate saying this, but I'm going to say it anyway, when the U.S. sneezes, the rest of the world catches a cold. If there's a significant slowdown in demand and activity on both consumers and businesses in the U.S., it's really hard for me to imagine that all these global multinationals domiciled in all these other markets won't feel it and that consumption patterns won't change.
So you don't buy into the erosion of U.S. exceptionalism?
I think the U.S. has some really exceptional parts of our economy and our corporate sector, but we are at a more challenging part of the cycle. The other thing I would say is, even going into this policy uncertainty, you guys know this very well, some of the macro data was slowing a little bit before any of this uncertainty was introduced. There were some pockets of retail and consumer. We were talking about that a year ago, remember? As we were going through first quarter earnings for 2024, everyone was saying, is the consumer cracking? It didn't fully crack. But as we got into the beginning part of this year, some of those fractures look more pronounced. So that happened before the policy uncertainty. And I think we have to keep a very close eye on that.
This speaks to the wait and see moment that so many people are in right now, not just businesses, but investors too.
I just want to know what's going to end that, right? If it's not April 2nd, if it's not necessarily guidance that companies can't give, what's going to give anyone a sense of conviction at a time of endless uncertainty?
Yeah. I wish I knew right now, and if I had the roadmap and my crystal ball was crystal clear, that would make me sleep a little bit better at night at this moment. But I will say here we are on a Friday morning, and we know a lot of investors, both fast money and real money, don't really want to go into the close today or into a weekend, super long risk, because of the uncertainty factor. I want to see a change in that overall behavior. Once we start to really neutralize some of the big overweights and sometimes underweights that people have had in their portfolios over the last couple of years, and people feel confident that what they're owning and what they're adding to can perform in a sustained way over multiple quarters, I'll sleep a lot better. I just don't think we're there yet.
Kate, it's good to see you.
Yeah, thanks for having me.
Happy to catch up. It's been too long.
Yes.
Hopefully we can do this more often. Kate Moore there of Citi Wealth. Kate, thank you. Cisco announcing plans this week to extend their partnership, creating their most advanced AI architecture package that will provide secure enterprise AI networking. I'm very pleased to say the Cisco Chief Product Officer and Executive Vice President Jeetendra Patel joins us now for more. Jeetendra, it's good to see you, sir.
John, it's great to see you. Thank you for having me.
Thank you for being here. I've wanted to do this for a while with you. We all have. Let's just take a giant step back before we get into this partnership. You know what I worry about? I worry that AI will do to services what manufacturing was done to by globalization. What is the risk of that happening over the next several decades?
Look, at any replatforming that happens, you'll always have some level of displacement of jobs, and we need to make sure that we make it as painless for society to make that transition happen. But I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. But if you take a step back, it's actually really exciting to see what the possibilities are with AI, because what people, even despite all the hype, what people grossly underestimate is the original insights that AI is going to be able to go derive that don't exist in the human corpus of knowledge that allow us to solve problems that we have not been able to solve until now. And so, whether it be in healthcare or financial services or transportation or whatever industry you pick, you will actually have a reimagination of the ways in which we can solve problems that have not existed up until now. And that's exciting, frankly, because you'll have this, population of 8 billion people that'll feel like it's got the throughput capacity of 80 billion.
Are we seeing that happen right now? Is that a dream for the future or something that's being realized in this very moment?
You're going to start seeing it happen in 2025. For example, there'll be, a meaningful amount of code that'll actually start getting autonomously written. And so you'll actually start to see so many more, the capacity of engineers will actually 10x during the course of 2025. It's exciting to see.
This, as you know, is the societal issue that I'd be slightly concerned about. So there are a bunch of graduates who are graduating over the next couple of years or so, and they went to learn to code because they were told this is what you need to go and learn to do. And they're coming out into a workforce where maybe they feel like they're no longer needed. What's the advice you'd give to them as they graduate?
Here's the thing that I feel like people, you might overestimate the capabilities on that front, because AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion that can actually do the stuff that they didn't really care to do or they weren't as good at doing. So this is a net positive in my mind, and you're going to see a lot of progress in society because of it, rather than a regression that happens.
Not to build on negativity, because I actually am a very big believer on the positivity, and I'm excited for it. But there is this question of who's going to lose their jobs in the meantime. And John alluded to this idea that it's more of a white-collar issue than a blue-collar issue. And I'm thinking of things that we've heard about, like at banks, where there have been fat fingers that cause transfers or whatever else, and that some of those efforts are being shifted to AI. How significant do you think that transition is going to be?
You will always have some degree of jobs that'll get displaced, and then there'll be new jobs that actually get created. And the thing that we have to keep in mind is there's a lot of jobs that right now people don't have enough labor to get done, that we just don't have the resources to do, that actually don't happen right now. And so what AI will allow us to do is not just go do things that humans don't do as well, not just do things that replace humans, but actually do things that humans don't have the time to get done.
Which industries do you think are being the most aggressive about adapting to different AI tools and bringing them into their infrastructure?
I think across the board you're seeing it right now. In fact, I'd say, 2 years ago when ChatGPT came out, almost every company in every industry went on noticing what's our AI strategy going to look like. And we've now had a couple of years to go bake that. And in 2025, you're going to see this really exciting move from just chatbots to agents, where you'll actually have workflows get automated in every industry, in every sector, in every segment of the market, in every geography. So I feel like there's only going to be two kinds of companies in the world, those that are going to be really dexterous for the use of AI and others that are going to really struggle for relevance.
Before we talk about facilitating that for corporate America, Jeetu, can we talk about how things are changing inside Cisco?
Yeah.
What's different about how Cisco's operating with these advancements that you're talking about?
We are lucky in the sense that we've actually got a front row seat on what's happening, and everything from the way in which we're building out infrastructure to the way in which we're getting our security and safety parameters in the right way, and then making sure that the workflows get automated. So, how are we using AI in engineering? How are we using AI in our contact center so that when customers call because they've got a problem, we're using AI to make sure that we can help them solve the problems faster? What are we doing in legal? What are we doing in marketing? What are we doing in sales? Each one of these areas is getting rethought and reimagined. It's actually exciting to see.
The whole world's got to do this.
Yes,
every company's got to do the same thing.
Every company, every government.
That introduces this partnership with NVIDIA. Talk to us about that and what's going to change over the next several years with that partnership in mind.
So we're excited. Jensen, the CEO of NVIDIA, put it best. He said Cisco and NVIDIA are putting together the blueprint for securing AI. And Look, John, I go talk to a lot of customers all the time, and when you go ask customers how enthusiastic they are about AI, virtually every CEO, we had a study we recently did, 97% of the CEOs said they were excited about AI, but only 1.7% felt prepared, right? And so there's this kind of dissonance between the preparedness and the level of enthusiasm that's there. And then you ask in the next level question, why do you not feel prepared? There's two reasons that come up. The first one is they don't feel like they've got the right infrastructure in place to make sure that they'll be able to harness the full potential of AI. And the second one is safety and security actually holds them back because they feel like it also is going to have a negative effect on adoption, because if you don't trust the system, you're not going to use it, right? And so those are two areas where Cisco helps customers out. And what we've done with NVIDIA is we just announced a partnership for this thing called the Secure AI Factory. Now, what is an AI factory? An AI factory essentially is a data center that's meticulously built for AI workloads. And what it allows you to do is make sure that you can create these data centers in the enterprise that can allow organizations to fully harness the potential of AI. And so we're jointly partnering over there. It'll be our networking, our security, their technologies. Look, Cisco is one of the greatest networking companies in the world. NVIDIA is a pioneer on the chips and actually created to some degree the movement in AI, and the combination of the two companies together. And I think you're going to see more and more of this where companies are going to partner with each other in this ecosystem to really go serve needs of customers and work backwards, even if there might be a slight competitive element.
This is fascinating to me because what it signifies is there's a growing number of companies that don't want to rely on the hyperscalers, that don't want to rely on the cloud systems to provide the artificial intelligence for their businesses. And it raises a question about the model that everyone has bought into in the market, which is that they will be the big beneficiaries. How much is that changing with companies not wanting to necessarily develop their artificial intelligence in the cloud for security reasons and want to have it in secure locations that keeps their data encapsulated?
I think you're going to have both. I think there's going to be probably the fastest growth that hyperscalers experience that they've ever experienced with AI, and there'll be the fastest growth that enterprises have because there will be some data centers that they'll want to repatriate back within the enterprise so that they can make sure that, and especially in areas like inference, you'll actually see a lot more of that. There's two big areas. There's training infrastructure that's needed to train the models, and then there's inferencing, which is what happens when you use the models. And on the inferencing side, you're seeing a fair amount of repatriation of data centers back in enterprise, and I think you're going to see a little bit of both. And we want to make sure that whether you're a hyperscaler, you're a service provider, you're an enterprise, Cisco wants to serve each one of them in a way that they can actually have infrastructure be plug and play. And it's massively simplified. It's still too complicated.
What's the role of government in this? There's tremendous competition around the world. Obviously, I'm thinking of Washington and Beijing. Do you like what you're hearing out of the administration?
I'm actually very optimistic about the kind of things that you're seeing across the board with the enthusiasm on AI. If we weren't talking about AI, I would be concerned. But right now, the governments are talking about it. They're talking about how automation happens within the government, how automation is happening in the private sector, how they're going to make sure that they can accelerate the innovation on those areas. So I think it's net positive.
Are we going to be replaced? That's all we care about.
No, John, you'll still be here, and 5 years from now, I'm still going to come and talk to you at this show, and it's not going to be an AI humanoid. It's going to be John.
That's all I wanted to know. That's all I care about.
How do you know I haven't already been replaced?
That would be incredibly worrying.
Sorry, carry on.
We had a guest recently. It was remote, and I worried it might be AI. Just didn't have a clue. You never know. You never know. You never know. GT,
I'm going to make you an optimist someday. This is going to be a fun world that we live in.
You're slowly converting me. I'm looking forward to being on this journey with you. GT, one of the best. Appreciate it. Thanks for being here, sir. Thank you. GT Patel there, the Cisco Chief Product Officer and Executive Vice President.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.